BTI reported their earnings last week as well as a dividend increase. So is this battered company with a yield touching 10% a strong undervalued buy with safe dividends? We're going to take a look on today's episode. As always, we'll run through the historical performance. We'll look at the updated numbers for December 2023 on the revenue side as well as the bottom line net income. We'll look at their cash versus their total debt to see whether or not this is a healthy company with those high dividends. We'll look at their total return over the last few years versus the industry and some well-known competitors. We'll also look towards the institutions, whether in the latest quarter as well as over the last 12 months, they are buying or selling British American tobacco. And we'll run it through a very quick screener for any insider buying and selling. And the important part, we'll look at their dividend safety. We'll run through their financial metrics to see if we can spot any issues over the next few years. And as always, we'll get them through the valuation model, getting to our updated intrinsic value, looking at the acceptable buy price given their investor margin of safety, and look towards Wall Street to see whether or not they still forecast upside from this company after releasing their annual report. So let's take a look at their historical performance. Now they're down 20% over the last 12 months. Do keep in mind this doesn't include those dividends reinvested, and over the last 10 years, as we can see, they are down 42%, and you have to go all the way back to around May 2017 to see their all-time highs, or at least over the last 10 years, of $73. They now currently trade pretty much towards their 52-week low, trailing 12-month yield of 9.5%. So let's take a look at their top line revenue. Now, over the last few years, what we want to see for these more mature companies, 3 to 7% growth year on year. BTI, 34 billion reported in 2019. December 2023, 35 billion. So we can see over the last 5 years, they haven't really grown that much, pretty flat. Now, when we look on the more granular level, they've increased slightly from 2019 to 2020, before a drop both years to 21 and 22, and then picking up in 2023. So for the last 10 years, we'll look at the percentage-wise shortly, but we can see relatively little movement to their top line over the last few years. But again, this is something that you need to understand that is very typical with the tobacco industry. A lot of people do see this as a dying industry, and there is an expectation that year on year that top line will continue to fall. We'll touch upon that as well in a bit shortly. Bottom line, well, 7.6 billion reported in net income in 2019, and we see in their latest annual report, bottom line net income, in fact, a net loss of $18 billion. So quite a huge swing. It went from 7.5, it did increase up to 2021 before decreasing in 2022, and we can now see a net loss in 2023. Now, the reason for this net loss is essentially due to the fact that they did take an impairment charge of around 27 billion. We can see here a non-cash impairment charge, 27.3 billion, relating to their acquired US combustible brands. Now, this is a non-cash charge, so if we do strip it out, we would see in actual fact they would have made a net income of around $60 billion. So yes, it has been increasing over the last few years, but we can see, similar to the top line, there is a lot of inconsistencies year on year. In terms of their total cash versus total debt, well, 3.5 billion of cash in short-term investments in 2019, nearly double that in the latest report, 6.7 billion. So they hold more cash. In terms of their total debt numerically and directionally, what we can see, it has also reduced 60 billion, which was relatively high, down to around 51. So nice to know over the last 5 years that in actual fact their top line or their cash is increasing whilst their bottom line total debt is decreasing. Now, when we take a look at some of their competitors in the industry, we have Altria Group, we have Japan Tobacco, Imperial Brands. We can see over the last year, BTI down 13%. Now, this includes if you had reinvested those dividends, and you can see not only are they worse performing, but they also lag behind their close competitor, Altria Group, negative 7%. Now, when we look at it over the last 5 years, what we can see that BTI is up 22%. Now, just something to bear in mind, yes, everyone loves British American Tobacco, Altria Group, their dividends are very high, 9, 10, 11%, but bear in mind on a total return basis, the performance is very poor over the last 5 years for both of them. But as I always do say, it is important also to understand the fact that past performance is never an indicator of future performance. Now, in terms of institutions, around 1.4 billion worth of sales of BTI over the last 12 months, just a little bit more buying over the same period. So institutions do like British American Tobacco more than they don't like, but they are very marginally buying more, as we can see. In fact, in Q1 of 2023, we see more selling. Q2 pretty much flat, same buys, same sells. Q3 and Q4, the most recent quarter, we see a little bit more buying. So again, take it with a pinch of salt in terms of what the institutions do. Always do your own due diligence, but there is little in between whether or not they like it or they don't. All we can say is the latest quarter, there has been more buying than selling. In terms of the insider screening, insider buys, insider sells, we've just run a very quick look through the insider machine, and we can see at least 100 shares over the last 1 year. There has been no buys or sells to note for BTI. Now, this is a good time just to let you know that for our free weekly newsletter that we do deliver once a week, our latest article we ran through insider buying and selling, talking about the most recent companies where management have been buying a significant amount of shares, as well as where management have been selling a lot of shares of their stock. If you want to grab a copy, completely free, click on that pinned comment below. There are also other articles you can gain access to, where one of them is our 7 golden dividend metrics, talking about how we identify undervalued companies. So let's take a look at the dividend safety score. So 45, borderline safe, we'll touch upon why. Market cap 67.6 billion, a large cap company. Now, some key metrics: they increased the dividend during the last recession, plus 5% sales, so above the average growth, but they did also outperform the recession return of the S&P, negative 31, to the S&P's negative 55. Dividend growth, well, 2% increase in February 24. Now, this was actually around 6%, but it may differ due to the FX rate, the currency, as this is a British company. In terms of the last 5 years, 3% increase year on year. Over the last 20 years, 9%. And we can see they are 1 year away from becoming a dividend aristocrat. Remember, that is a company that has increased those dividends for the last 25 years or more. In terms of dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 9.82 versus 7.47. Although do bear in mind, we're not looking at any of these models in isolation, and we will conclude towards the end of the episode. We then focus on the free cash flow payout. As always, remember the earnings is susceptible to manipulation by management through accounting. We've done a ton of examples on the channel and will continue to do so, just to point that out. So below 85% is the preference for tobacco companies, as they do pay the majority of their earnings and free cash flow as dividends. Nice to note that for BTI, for the last 7 years, it has been around the mid 50s and low 50s. 2023, the most recent period, 51%. 2024 at 66% is still quite strong, very positive in my opinion for a tobacco company. Now, free cash flow per share, nice to note it has been increasing, 162 in 2014, 455 in 2023. It is moving in the right direction over the longer term. But again, bear in mind the type of industry this is. You won't see fast growing movements to the free cash flow. 2024, however, it is expected to drop down to 357. Now, sales growth, this is what we want to point out. Now, with the tobacco industry, people are saying, or the industry experts, that this is a declining industry over time. Now, we can see just over the last 4 years, we've had 2 years of flat growth, the more recent period of -1, 2022 at 8%. So just bear this in mind, understand the risks with investing in a tobacco company. Yes, it's positive and nice to note that a company does pay a nice high yield, but bear in mind the future, if there are issues with their top line, with their profitability, then this could eradicate a lot of that yield. Total sales then, 14 billion in 2014, 27 in 2023, essentially doubled their top line over that period. Very nice to note. Unfortunately, whilst we love it when companies do share buybacks, returning excess cash to investor pockets, BTI, they've done the opposite. They've diluted your position over the longer term. And we can see it's gone from 1.87 billion to 2.23. So always something just to be aware of. ROIC, though, it is one of my 7 golden dividend metrics. So if you do read that copy, the free weekly newsletter running through the 7 golden metrics, this is one of them. I want to see around 10% or more. Gives me faith, or part faith, that management are able to effectively allocate their capital. BTI, The last year, 12% is nice to note, but this is fairly struggling over the last 7 to 8 years. If you have seen our reviews of Ultra Group, you'll note that they have some very strong ROIC figures consistently over the last 10 years. In more positive news, the operating margin is very strong, above the minimum 25%, and it has been increasing over the period. The more recent year, 46%, very strong, very healthy. Likewise, with the free cash flow margin, it has been increasing and is moving in the right direction. 37% in 2023, very strong to note. Net debt to EBITDA, earnings before interest, tax, depreciation and amortization, shows us two things: the dividend safety as well as the balance sheet strength. We want to see below 3 for tobacco companies. 2.64, so that's the number of years it would take BTI to pay off all of their debt net of cash on hand. 2024 expect to be pretty much the same, so it is below the 3. Now, that in conjunction with the fairly strong payout ratio, which is around that 50 to 60%, it does look like that dividend does seem to be safe for the time being, although that will be impacted over the next few years if the revenue does continue to decrease. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model, Graham's valuation, we have the earnings per share, the long-term growth rate, the corporate bond yield, and we get an intrinsic value of $45. So we have our first sign of undervaluation given the current market value, but do bear in mind we don't look at any of these models in isolation. We then have the multiples valuation model, companies in a similar sector and size, very well-known competitors. The average P multiplied by the EPS of BTI to get an intrinsic value. Again, some strong signs here of undervaluation. We then move on to the dividend discount model where we have the growth rate year on year. Again, do note the negative, there was no dividend cut, just the FX rates will have some differences for US investors. Growth rate, we've gone very, very conservative at 1.75%, and we can see based on that as well, we do see some intrinsic value higher than the market value, so another sign of undervaluation. Now the DCF model with our free cash flows year on year, the average growth rate of 12%, we've gone more conservative than analyst estimates again, negative 5%, expecting that free cash flow to reduce 5% year on year. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we have an intrinsic value of $38.85. Again, a fourth and final undervaluation signal. We then get to what is the intrinsic value, the average of these four models, and for today's episode of BTI comes to $48. As always, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, you can click on that pinned comment below. Margin of safety then, we start off with 10% if we believe it meets 3 criteria: wide moat, strong financial metrics, good forward-looking data. 10% it is a buy up to $43, and we keep going till it's roughly near the current trading price. And at 30% it is a buy up to $34. 35% pretty much not too far off the current trading price. So we see a 35% margin of safety based on the updated numbers of their annual report. And when we look at Wall Street after this earnings, their new adjusted price forecast is $39. So whilst it is below the intrinsic value, they still see 29% upside, so they do consider this to be a strong buy, bearing in mind that it also has a very nice high yield. Now, the only thing that I would mention here, there are some risks around regulation as well that we have covered a lot. There were countries that were looking to ban cigarettes from a certain age, and we have essentially BTI, Philip Morris, a lot of these big tobacco companies are looking to bring out non-combustible income streams as well. So it really depends on where you sit on the fence of the tobacco industry, whether you think this is a dying industry and a lot of these big name players won't be able to pivot slightly and capture a stronger market and moving out of purely just the combustible revenue. As always though, do let us know your thoughts in the comments below, whether or not this is one you're buying. Maybe you're looking at Ultra as a better alternative, or even Philip Morris. As always, if you enjoyed today's content, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.